Welcome to Passive Investors Playbook. I'm your host, Charlie Hardage. In each episode, we'll sit down with successful people that turn to real estate to build and grow their wealth. We do a deep dive into why they chose real estate and what makes it so attractive to them. We explore why people in their industry could also benefit from passively investing in real estate. Whether you're a beginner or an experienced investor, a doctor or a professional athlete, love your job or hate your job, our show is here to help you build a profitable real estate portfolio while maximizing your free time and minimizing stress. So sit back, relax, and get ready to learn from some of the best in the business. Welcome to Passive Investors Playbook. Thank you for tuning in today. My name is Charlie Hardage, and I am the host of the Passive Investors Playbook. Today, I have a very special guest, Tim Little. Tim is the founder and CEO of Zana Investments, a Tampa-based real estate investment firm. Zana is named after his two daughters, Zara and Lana. Tim is passionate about helping fellow military veterans escape the landlord trap and get competitive returns by providing opportunities to passively invest in apartment buildings. Tim started investing in real estate with a duplex in 2014 and has now grown to a portfolio of almost 700 co-owned units valued at almost $100 million. Tim also practices what he preaches by passively investing in apartments. Tim has been in the military for 27 years and is a very proud member of the armed forces. Tim, thank you so much for being on the show today. I really appreciate you being here. I'm really excited to hear your story. Do you mind sharing with the audience a little bit more about yourself?
Sure, Charlie, and I appreciate you having me on. So, like you said, a lot of my background is military. Did that straight out of high school, then wound up going to college at Florida State, go Noles, where I stayed in the Army Reserve and really had no intention of going back in active duty until an ROTC recruiter got to me and convinced me that there might be some benefits to having a guaranteed job when I graduated from college. So I wound up doing that, being active duty as an officer till about 2008 is when I got off of active duty, went into the reserves and went to grad school to get smart again. And then I went into the corporate world like a lot of people do because I was following what I thought were the proper financial footsteps of, getting an education, getting a comfy job and saving for retirement. But at some point along that way, the real estate bug got a hold of me. And, I tell people sometimes you need to be in the right place at the right time to take advantage of opportunities. And I first got introduced to real estate, maybe in like 2004 when I read Rich Dad, Poor Dad. And I went to a convention that had all kinds of stuff, one of which was real estate. And they were talking about driving for dollars and, helping little old ladies whose husbands just died, buy their house, et cetera, et cetera. Not the most savory aspects of real estate, but I recognized the benefit of it. And so I wanted to get into it then, but wound up getting deployed right after that for an extended period of time and just didn't have the opportunity, and life kind of got in the way until after grad school, when I wasn't a poor college student anymore, started to have a little bit of money in my pocket, but a lot more debt, but decided I wasn't going to let that stop me from at least starting to invest. And that's when I started listening to the podcasts and reading all the books I could find on real estate. And like most people, I just, started with, okay, how many single family properties will I need to reach my freedom number, to replace my income? And I quickly realized that's a really high number and that it's not that easy to buy that many single family properties. So then I was like, okay, let me split this in half and we'll go duplexes because, when you get into duplexes in any multifamily, even small multifamily, you start to mitigate some of the risk involved. And so by buying duplexes, I could have, even if one unit is empty, I may still have the other unit that's rented up and that's providing, enough to cover the mortgage, as an example. And so that's when I decided to finally take action in, I think it was 2014. I bought my first intentional investment property, which was a duplex in Richmond, Virginia. And happy to talk about the details on that if you'd like.
Yeah. Thanks, Tim. So about 2014, you read Rich Dad Poor Dad. I'm assuming right after high school, you went into the military as enlisted, and then you got out, you went to Florida State, and you were done with the military, or so you thought. And then a recruiter, an ROTC recruiter, got to you and said, hey, why don't we pay for school, and now you have a guaranteed job or something like that. And so you went that route. 2004, you read Rich Dad Poor Dad, trying to figure out how many single family homes you needed to hit your freedom number, realized it's not going to happen anytime soon. And then you went to duplexes. And I like what you said there, Tim. In 2014, you bought your first intentional rental. I'm assuming you had rentals, but it was a house that maybe you lived in, and then you, instead of selling it when you moved, you rented it out. Is that correct?
Exactly. I became the accidental landlord, as they call it. And because it wasn't intentional, that's why I don't really count it as an investment property. I don't think I made any money off of it. It was enough to pay the mortgage. And then, we had to sell it a couple of years later. So I don't even view that as an investment. That's not to say that some people that do rent out their previous residence aren't good rental properties. It's just because I wasn't intentional about that one. The numbers weren't great from a cash flow perspective or anything like that.
Yeah. And I think that's really important to note, because I think a lot of people are in that same position of, well, we could, if they're moving, they could sell the current house or they could rent it out, but it wasn't meant to be a rental. And so the numbers don't always make sense. And, to your point, sure, maybe it's cash flowing a little bit, but it wasn't meant to be a rental. And so it might not really make sense to hold on to it as a rental long-term. And you realize somewhere in there that, single family wasn't necessarily the best route. So you went with the duplex route, which I think is very admirable, that you kind of saw that single family wasn't the best way to do it. And in order to mitigate risk, you looked at duplexes and small multifamily. I guess, why did you pick real estate as a good way to kind of hit that freedom number? Was it just because of Rich Dad Poor Dad and some of the conferences, or why real estate?
Yeah. So I'd say it's a couple of things. Rich Dad Poor Dad was like kind of an inspiration for that. Yeah. But there was also other reasons as well. I looked at the stock market. I had stuff in like a TSP, which is the military equivalent of a 401k. And I saw it get halved during the financial crisis. Now, granted, I didn't have a ton of money in there anyways, but, still when it goes from, say 40,000 to 20,000, that still hurts, because you still put, a lot of time and effort into, saving for that money, and you're hoping that it's going to be there down the road. So, post 2009, and it was, half of what it was before, I really saw and started to understand the volatility of the stock market. And sure, a lot of times it goes up, but when it goes down, it can really go down. And the thing that bothered me was how little control I had over that. Yeah. Whereas when we talk about real estate, one, it's a real thing. We can control it, whether it's that house that we buy a fixer upper, or whether it's a 100-unit apartment building and we force appreciation by adding amenities that we can charge more rent for. In either case, we have control over how much that asset is worth to a certain extent, whereas we don't have that same control with stocks. And the analogy that I like to make with people is, hey, listen, it doesn't matter how many Cokes I buy and drink, it is not going to move the needle on the price of Coke in terms of their stock. So that was one of the biggest reasons why I really focused on real estate.
Yeah, I think a lot of myself included, but a lot of the guests are just like you, Tim. That control is huge, right? And I think the very common in real estate, you do have control, whether that's investing in certain markets or a certain property. You can control, do you fix up the unit? Certain types of tenants go in there, whatever it is. There's a lot more control in that than the stock market, right? And to your point, you could throw the biggest party ever and buy 2 liters of Coke and whatever it is. It's not gonna move the needle at all, right? So I am totally on board with you about the control aspect and how that's just great with real estate. So you read Rich Dad Poor Dad, and that was a big influence on you. You realized that in 07, 08, 09, sometime in there, your TSP that you worked extremely hard for went from went down 50% basically. Yeah. And one of the common misconceptions about the stock market too is it doesn't have to go up by 50% to regain that, where your number is. If it drops by 50%, now it has to double, it has to go up by 100% just to hit that same number that you were at. And so I think, it's, if something drops by 50%, it's pretty unlikely it's going to go up by 100%, in a year or two. And so, TSP, just like 401k, it can be nice, but at the same time, there's no control over it. Usually there's very few investments, and usually you're paying mutual fund managers and just a lot of fees on top of that that definitely add up. So walk me through in about 2014, you bought a duplex. When did you go to apartments? When did you say, hey, duplexes are okay, but I'm looking for something bigger?
Yeah, and so that happened around 2017. So I had the duplex. It was doing fine, and then I wound up moving a few years later in 2016 here to Tampa from DC, and I wound up doing a 1031 exchange of my duplex into a triplex here in the Tampa Bay area. And the reason I did that was basically to kind of scale up, right? So I wound up getting more units. Each unit had better cash flow than the duplex that I had in Richmond, but also it was closer. So then I was self-managing. So I was saving 10% of what that property manager was going to charge me. So it seemed like a really good decision at the time. But what I found is that by self-managing, it was taking up a lot of my time, and it was providing me a lot of headaches. Again, the cash flow was great. I was getting probably $200 per door cash flow every month. But it just, at a certain point, it was taking away from what at that time is when I started learning about multifamily syndication and investing in apartment buildings, because prior to that point, I just had never heard of that. I didn't know what that was. And it wasn't until I think it was 2017 when I went to a conference that was just all about multifamily syndication, because I had heard a couple of podcasts about it and I was intrigued, but it didn't make a whole lot of sense to me yet. Yeah. Right. I didn't understand enough to kind of connect the dots. So I went to this conference, and it was like drinking from a fire hose the entire time. And I was just like, oh, because they went over underwriting, they went over, picking markets, they went over every aspect. And it was just a lot to take in for just being introduced to a topic. But I was like, okay, like I was convinced that it made sense. And that's kind of when I decided that this is something I at least want to try out. I wasn't convinced at that point I wanted to dive into the deep end or anything, but I was like, all right, what can I do to get into this? And so I was like, maybe I could be a passive investor. And, of course, at the end of this one, they were trying to, sell me a $25,000 coaching seminar. I was like, whoa. Like, I just learned about this thing. I think it's good, but, and I was about to go on a deployment, and I knew I'd be gone for about a year. So there's no way I'd be able to take advantage
Yeah.
of any kind of coaching program. So that's why it made a lot more sense for me to passively invest. And I was like, what I tell people is it's the best of both worlds, because you can learn while you earn. Instead of paying money, with the potential to get return on it, through education, I was investing money while at the same time having the opportunity to ask all the questions I wanted.
Yeah.
I mean, within reason, right? I didn't want to like bug the sponsor or anything, but I was able to ask questions of that sponsor and really learn more about the process, especially from the investor's side, and get all the stupid questions out of the way with someone who was very understanding and patient with me as a new investor. And so I think that went a long way. And so that's when I made my first passive investment in 2017, which I put in about $25,000 because that was the minimum that they would take. And that's exactly what I did. After talking with them, kind of checking out the deal, doing the best underwriting that I could at the time with my limited knowledge, I went ahead and invested right before going on that deployment, and just kind of waited around for a distribution check, hoping that this wasn't all some big scam.
Yeah. About 2017, I think you said you deployed sometime in there. You invested passively in an apartment complex, which made sense since you were overseas and couldn't really do much anyway. And I love what you said, Tim, how you did that first because you went to the conference, you were drinking through a fire hose, so much to learn. And instead of paying, 25 grand for the coaching program that you wouldn't have been able to take access, you wouldn't have been able to learn anything with that because you were gone. Instead, you took that 25,000, invested into a deal. You were able to have your money work for you instead of you working for the money. And you were still able to learn a lot because you were able to ask questions. You got some distributions. And so then when you came back, probably able to understand it a lot more. How, to go back to the triplex, ballpark, you were making about $600 a month, but you were self-managing that. Maybe you weren't making quite $600 a month with the apartment complex that you passively invested in, but you weren't spending much time on that at all, right? I mean, your time probably had a lot more free time because you weren't self-managing the apartment complex and the triplex, but you're probably making a pretty good, ROI or return on your time, really.
Yeah, absolutely. And that's the thing with the passive investment. After you do your due diligence upfront to make sure that this deal makes sense for you, your investing goals, etc. After that, like the time spent is really just the, 15 to 20 minutes it takes you to read the monthly updates that you get on that investment every month. But, thinking through the timeline, it was after I returned from that deployment that I wound up getting the triplex, because needless to say, during the deployment, I was also listening to a lot of podcasts, learning more about 1031s and stuff like that. And so I wound up doing the 1031 then into the triplex, which if people aren't familiar with the 1031, and you could do this with regular houses too, this is not a multifamily thing. You're able to take the proceeds from the sale of one building and put it into another. That way, I didn't have to come out of pocket at all to buy this, significantly more expensive multifamily property. So just to provide some context, the duplex that I bought in Richmond back in like 2014, I bought that for $85,000, which almost sounds ridiculous because it wasn't like in downtown. It was in the lower income area of Richmond. And so it was also like 100-year-old house that they had just kind of divided in half. But the market was getting so hot around, the 2017, 2018 timeframe for multis, especially in Richmond, that people were buying them up. And so I got an offer for $150,000
Wow.
with no contingency for inspection, which on a 100-year-old house makes a big difference.
Yeah.
Because they will find something. And I was just like, sold. I was like, I got a decent return. They're not going to do an inspection. So I was like, I felt like that deal had run its course. And so it was, I think, 2018 that I wound up doing the 1031 exchange into this triplex, which is here in St. Pete, which was probably, I think it was paid like $385 for that, 365 for that. So again, significantly more expensive, but zero money out of my pocket because I just took those proceeds directly from one to the other.
Very cool. And so the 1031, you kind of touched on it a couple minutes ago, but 1031 is just a tax defer that the government allows basically to buy a bigger property, a like property, but bigger. There's a lot of stipulations with that, but the reason that the government allows that is because they know that you're going to be spending more money, and so they'll get more taxes later on down the road, and that's the big reason that government allows 1031. So eventually you'll pay taxes on that, or maybe you already did, but they defer that. So Tim, want to kind of transition slightly. So you've been very successful. You've been in the military for 27 years or so. I know you did a little bit of government consulting as well. Why real estate? Like, what makes real estate so attractive to you?
So at this point, I talked a little bit more about the level of control I have over it. But now, like, as I got into the commercial multifamily side of things, it was really the ability to scale. So like you mentioned at the top of the show, I still continue to passively invest. And that's what I do with my retirement account. So what I did is I rolled my TSP over into a solo 401k so that I have control over how I invest it. I don't have to put it in fund A, B, C, and D. I literally have checkbook control where I can write a check for a passive investment in a commercial multifamily property. And that's what I do. And it's done very well for me. So I keep that, for the retirement side of things. But I've made commercial syndication my full-time job. And so in that, I'm the general partner. I'm the one putting the deal together and helping investors get their money into these deals so that they can see the same kind of returns and tax benefits that I've been seeing. So that's what I'm doing now.
That's awesome. So obviously the control aspect is huge for you, and I think a lot of people. But then also one of the reasons you love real estate is because, or apartments, is because it provides the ability to scale, which I think that just the scalability of apartments, I think that we could talk about that for a couple hours. So I don't want to go into too much depth with that. But one of the really cool things that you mentioned is you took your TSP, the thrift savings plan, which is essentially the government's 401k, and you rolled that over to a solo 401k. And with that, you are able to invest in so many other things. It's not just the handful of funds that the TSP offers. Now you can invest that solo 401k into literally almost anything you want. I've heard some people invest in like racing horses or cattle or things like that. I know you're not doing that, but no. You're taking that TSP that is now a solo 401k and you're investing into more apartment complexes because you just obviously truly believe in the power of real estate and love that it's passive, right? You can invest and still have that control, but you're getting all the benefits of real estate, all the benefits of apartments, and that passive side of things. So again, you do your due diligence up front, and now you're spending maybe 15, 20 minutes a month just kind of going over the emails that the partners send out. And obviously, if you have questions, you can reach out to the general partners and they can answer those for you. So I love that. And that's, I think rolling it over to a solo 401k or self-directed IRA, whatever the term would be, there's so many benefits to that. I don't think that's very common knowledge though. I only heard about that a couple of years ago. Do you want to maybe talk about that process of rolling it over? Like how long did it take you? How hard was it? And just talk about that a little bit.
Sure. And that's exactly why I mentioned it, because so few people know about it. And I
Yeah.
think it's very powerful in the sense that a lot of people just don't think they have enough money to passively invest, right? Because it's true. A lot of deals have a 50,000 minimum. Some have
Yeah.
100,000 minimum. And most people do not have that kind of money just sitting in their savings account. So I think it's very powerful in the sense that people can say, oh, well, I do have this orphaned 401k from that job that I quit, 6 years ago.
Yeah.
And it's just kind of been sitting there doing its thing. And so that's still viable money. And in terms of the process, it's really not that hard. Solo 401k is a little more legally complex. And so in order to protect myself, I had to, there's a certain legal structure to it that is a little bit more expensive for on initial setup, but it's in maintenance, but it's really not that bad. I'm definitely happy to do that for the flexibility that it provides me.
Yeah.
But more commonly, there's, just the, like you talked about, self-directed IRA, which makes more sense for most people. I have the solo 401k because I do have an LLC. I do have a business, but you can't have any employees. That's a big restriction of a solo 401k. You cannot have any full-time employees. So
Okay.
if the LLC that I have it under ever goes, beyond one full-time employee, then I have to change it. So that is a limitation. Like anything, there are pluses and minuses. But with a regular self-directed IRA, it's not that hard to set up. I think the biggest challenge is finding a bank that understands it. And so whoever sets up your self-directed IRA, they usually have relationships with banks, because a lot of banks are like, no, you can't do that. That doesn't make sense, because they're just as clueless as most people are, which is unfortunate. So just really finding the bank that understands it so that you can have that checkbook control and make the investments that you want that are allowable. And just to be clear, it's not a panacea, right? Like there are some drawbacks to investing with a self-directed IRA. The biggest one is you don't get the tax benefits because because it's a retirement plan.
Yeah.
So and there's also a UBIT tax, and this is really in the weeds, so I don't want to go into UBIT and UDFI or whatever it's called. But they're basically taxes levied against the amount borrowed for the investment. So not the total thing, it would just be for the mortgage portion. So it doesn't mean that the deal won't make sense. It's just you have to crunch the numbers to see if the deal still does make sense for you and what your investing goals are. So again, a little wonky, a little in the weeds, but just something for people to think about. There's calculators out there you can do this stuff on. But in terms of the flexibility that it provides you, I think it's unrivaled.
Yeah. And UBIT stands for unrelated business income tax. I forget what the other one stands for, but maybe we'll move on, and I'll just say to the audience, anyone that has a TSP that is interested in doing something like Tim did and rolling that to a solo 401k, reach out to Tim. I'm going to provide, or he's going to provide his information at the end of the show, and just reach out to him, and he can at least help you, point you in the right direction, and maybe link you up with some of his contacts as well, because I think it's extremely powerful. It offers that control, offers the ability to scale, and a lot of my audience does have a TSP as well. So I just think that's so powerful, because most people don't know you can roll that over to a 401k or a self-directed IRA. So I think that's really powerful. TSPs aren't bad, but they are very, very limited, and not just TSPs, 401ks are like that too. And a lot of times, if you're in a company, you have a 401k, when you leave that company, that 401k is still there. I had a 401k that was about 12 years old, just sitting there. up until about 3 years ago, just because I kind of forgot about it.
Yep.
But anyway, very cool. So I want to talk about your first deal. You kind of hit on it, but a lot of my audience is kind of curious, like, and you already said it a little bit, but if they don't have the cash, and I want to talk about you specifically, Tim, but how did you come up with the capital for your first investments in apartments?
Okay, so for my first investments in apartments, that was really just saving up, right?
Okay.
Like, and we were in a dual income household at the time, right? We were both making decent money. I just had very oppressive debt also. So I had about 130,000 in school loan debt from grad school. So I was aggressively paying that down at a rate of about 1,500 a month. But we bought very cheaply in DC, as cheaply as you can. So we didn't go crazy there. And then even when we came to Tampa, again, we didn't go crazy. So we've always lived below our means so that we could save up enough money to invest. So I think you have to be intentional about how you're doing it. We have a very strict rule in our household of only one car payment at a time, for example.
Yeah.
Right. And if you can imagine, if you got two people each with, $500 a month, and that's probably low, car payment, just imagine how that money could be saved towards investing. And so that's where we were, only one of us had a car payment. And we were trying to aggressively save too. So we were able to save up, like I said, 25,000, which at the time was a lot of money for us. And that was the minimum that I could find for a deal in terms of passively investing. So was it easy to save up that amount? Not necessarily. Again, we made a conscious effort to live below our means. And then the other key point was when we sold our house in Washington, D.C., we made a decent amount of money, right? We made, like, I'd say 85,000 free and clear from the sale of that house. So what I did is I wrote a check for about 83,000 and some change to completely pay off my student loans.
Okay.
Now, having that extra $1,500 a month available to me made a huge difference in terms of ability to save, right? So that also made a huge difference, just getting rid of that debt. And so I think those were the things that really helped us on that road. The other thing was when we moved here to Florida, I wound up using my VA loan and putting zero down on the house. So again, saving a huge chunk of money that I would have otherwise had to use on my own residence. And so that was basically applied to investment.
That's awesome. And then you also use the TSP to invest passively. And so I know you've done that and probably grown that very, very considerably over the years. What would you say your company goals are over the next 12 months or so?
Yeah, and this has shifted a little bit, right? So, when you first get started as an active, general partner, you're like, you want to get that first deal done. After that, then we have a tendency to focus on number of doors. I want 1,000 doors or whatever. But I quickly came to realize that some of those, and I'll call them vanity metrics, don't necessarily mean a whole lot. Dirty little secret, because it's not necessarily representative of, how much money you're making or how many people you're helping. So what I've done is I've shifted my focus to how much money I raise, right? So say I'll raise, I want to raise 3 million within the next year. Now, what that allows me to do is, obviously buy larger properties and more doors, but more importantly than that, I'm able to help out that many more investors, because that means I've introduced this opportunity to them. I've explained to them what passive investing is. More people understand it. Yeah. So the more veterans, who is my key audience, that I'm able to open up to this opportunity, then that's kind of reflected in the how much money is raised. So that's why I kind of switched to that. And I'd say within the next year, 3 million is my goal. And then, maybe double it the year after that. And we'll just see where it goes. Some of these things are kind of hard to gauge in terms of how fast they can grow. So,
yeah, I love that, Tim, because I know, like you said, number of doors, I do think it's nice, helps the resume, but
sure.
At the end of the day, it is kind of a vanity metric. And so I really love what you're doing about instead of number of doors, how much can you raise? Because I think I was extremely impacted when I heard about multifamily syndication. A lot of veterans aren't making a ton of money. And so when they can hear about something like this is just really profound and helps them. Maybe they want to stay in the military because they love it. But the pension isn't, there is a pension, which is nice, but it's not this huge number that people may think it is, right? It's, after 20 years, it's 50%, which that's only the salary. That doesn't include all the perks like housing and food and stuff like that. So it really allows them to kind of focus on their future as opposed to having to get another job and if they're investing and growing their future, their financial future. So I love that is your focus more on how many people can you help rather than number of doors. And I want to talk about a little bit about a cheat sheet that you have on your website. I think that's a really good place to start if you are interested in learning more about what multifamily syndication is, especially if you're a veteran. Can you plug your website, say what that is, and then also kind of talk about your cheat sheet a little bit?
Sure. So anyone can go to my website, zanainvestments.com. That's ZANA and then investments.com. And then I have a what I call the passive investor cheat sheet on there, which is basically the top 33 multifamily terms that people need to really understand in order to start confidently investing passively. Because what I found is like any industry, there's a lot of jargon, a lot of terms that we throw around that aren't obvious upon first listen. So what I did is I didn't do textbook definitions. I literally, explained what each of them means and tried to provide examples to illustrate it so that it makes more sense. Well, that's the way I think, and I think it's the way a lot of people think. So if people want to download that, they can go to zanainvestments.com/cheat sheet, and they can get that there for free.
Awesome. Sounds good. And then is your, I know you're on, you have a podcast. I was on there a couple of weeks ago, Journey to Multifamily Millions. Is that, can they find out more information on your website as well about the podcast?
Yeah, we have a tab on the website as well, where they can, I think it has like, additional info or something or resources, something like that. And
okay.
They can go on there. They can see some of the webinars that I've done, having experts on, and they can also see the podcast and all the places that they can go for that. So if they go to the resources tab, that'll drop down to the ebook, which is the cheat sheet, and then they'll see podcasts and they'll see blogs as well. They want to check some of those out. Okay,
awesome. We'll put that in the show notes as well. The cheat sheet that has 33 terms that are broken down in actual English, not Webster's English. And then your podcast, Journey to Multifamily Millions. People can find out more information on the website. Your podcast is on all the major podcast platforms as well. So I definitely recommend going to Tim's website and just kind of exploring, because they have a lot of educational goodies on there: cheat sheets, webinars, podcasts, blogs, all that. Awesome. Okay, so Tim, how do you think that your profession, being in the military, just in general, how do you think that helped you in real estate, specifically more apartments, and being an active general partner as opposed to a passive investor?
Yeah, so I think the biggest thing is management. As an officer, especially, we don't necessarily need to be experts at every single job of the people that work underneath us. We just need to understand them enough to best integrate their efforts, right? And so it's very similar when you're an asset manager on a deal like this. And what the role of the asset manager is to basically manage the property manager and to ensure that the business plan gets implemented. So think of like, if you have construction going on that property, making sure that it's to time and cost, and just following up on all the metrics, the key performance indicators that you have for that property manager or general contractor, or whatever the case may be, and getting in on those meetings every week, so that you can kind of hold them to task for the promises that they've made. And frankly, those are the promises that you've made to your investors.
Yeah.
So you need to be diligent, because if you don't manage the property manager, they'll manage it the way they think is best, and that's not always in your best interests. So especially when it comes to budgets, hiring, that kind of stuff, because it can quickly get away from you if you don't stay on top of it. So I think the management piece is really the greatest benefit from my military experience.
Yeah, I love that. And asset managers, I think are such a key role, and that's why I don't do it, because I'm not organized. But I think asset managers are just such a key role in the business, in the investment, because they do manage like you said, they manage the property manager. Just because you're not the lead asset manager or even the asset manager doesn't mean you can't be on calls, right? And I'm on a lot of calls just because I like to know. I have investors that I talk to as well, and I want to know what's going on with the property. But an asset manager is basically like a project manager, right? So they're the ones that are guiding the property management, making sure that the business plan is executed, kind of what your pitch deck says, what you told your investors. So very, very cool. I love that that side of the military and being an officer of that management. And I love what you said, Tim. You don't have to be an expert in everything, right? And you're not. And if you were, that would probably all your time would be used because you're the expert in everything, and that's just not the case. Anyway, very, very cool. So I know we have a few minutes left. I want to talk about a recent book that you've read that stands out, business or self-help or real estate related.
Sure. So I think the one that I'm listening to right now, I'll admit I listen to more books than I
Me too.
read.
Me too. It's okay.
read on paper. I think what I'm listening to right now is called Fanatical Prospecting. And it's more of a sales book, but it gets away from the idea that sales has to be this slimy, gross thing that people don't like, because I think I have some of those preconceived notions as well. And I'm like, I don't want to like sell people but it's more about, being able to talk to as many people as possible to get your message out.
Yeah.
Like I get on here and I try to do educational content on TikTok and Instagram, and that's to teach people. Now, is my core audience on TikTok? Probably not, right? Just if you're looking strictly at average income and stuff like that, there's probably not nearly as many people on there as, say, on LinkedIn who could even afford to passively invest.
Yeah.
But looking at the long term, right? If I provide people this education and I provide them with value, maybe 5 years from now, and I assume I'll still be doing this, maybe then they're like, hey, he's provided all this value to me. The only reason I understand it is because, I was listening to his TikToks. Maybe then they decide they want to invest with me.
Yeah.
And so it's really a matter of looking at it over that long term. But this book, Fanatical Prospecting, just basically tells you have to get out of your comfort zone and not just let prospecting be on autopilot, right? It can't just be, hey, I shot emails out, all the leads will come to me. Because it's more than that. You have to actually talk to people. If you're in a coffee shop, you say hi, you strike up a conversation. If you're at a conference, you talk to people, you tell them what they do. And so every time you're around people is an opportunity for a new customer to develop a new relationship and to let someone know what it is you do, because who knows, that person may be the one who can most benefit from what you do.
Love that. So, and one thing I'll say too, when I was trying to raise capital at the very beginning, I did feel like it was sales. And about a year and a half ago, kind of changed my mindset, because when I think about myself, I was so impacted by multifamily syndication, being able to passively invest and feeling like I'm now taking control of my retirement. Anytime I'm talking to someone new, I don't think it's sales anymore. I think what we're doing, Tim, is providing a great opportunity for someone else to be impacted just like we were, or just like I was, right? I was so impacted by it. And so I don't feel like it's sales anymore. I do feel like it's, what we do is provide a great opportunity to someone who may not know about it. And so if you want some educational videos, follow Tim. He does not do any dance videos. Maybe he does on TikTok, but no. What can people expect to see from you and your business over the next few years?
Yeah, and so I think in terms of our presence, that's what I'm really trying to grow right now. I'm trying to obviously get on more podcasts. I have my own podcast, but that's a very slow burn, right? It takes a long time to build an audience for a podcast. So just in terms of getting in front of more people, I want to go on more podcasts. I'm also considering, speaking events, but that's, again, getting outside of that comfort zone. I think most people know how people feel about speaking in public, but that's something I want to get over. So again, I can continue to grow how much I raise, and not just, we talked about how much that can help more people, and certainly grow your portfolio. But the other aspect for our business is finding our own deals, right? A lot of times what we've been doing, and this is common when you start out as a new GP, is you become a co-GP with someone else. Say they find the deal and you help, raise money, do due diligence, do asset management, whatever it is, to add value to that. But, the person who finds the deal has the biggest chunk because they control it, right? And that's fair. Well, I obviously want to start having a larger slice of the pie. So I need to start finding my own pie that makes sense, and then inviting others in to help with those deals. That way I have more of a controlling asset. And then that also gives me more of an opportunity to kind of flex the full ownership. The prime sponsor is the title for the person who finds it and is in control of it. Because you don't get as much of that when you're a co-GP. There's varying levels of control and information you get as a co-GP. Whereas if you're in charge, obviously you set the rules. So that's the other big thing that we're looking at. Finding more of our own deals. It's just a little challenging in this environment where a lot of deals are not making sense, just numbers wise. But we're continuing to underwrite, and hopefully we'll find those diamonds in the rough that still provide a good enough return for our investors.
Awesome, very cool. And then we're going to plug all your social media and the website and podcasts in the show notes. But can you, what's the best way for people to reach you?
Sure. I mean, anyone can email me, tim@zanainvestments.com. Or I stay very active on LinkedIn. So by all means, connect with me there. And then I think you guys can have my phone number in the show notes. That's fine too. I don't mind putting it out here, but otherwise email is honestly the best way. And I'm on all the socials. But yeah, I'd say email if you want to get a hold of me, and LinkedIn is the other place where I'm most active. Okay, very cool. Well, Tim, man, thank you so much for being here. I love, obviously I was in the military. I have a very soft spot for military and government employees as well, because I know
a lot of times the pay's not great. It's not necessarily a 40-hour work week. A lot of them work a lot more than 40 hours, and it's not the easiest of jobs. And so thank you so much for being here. Thank you for helping military and government employees as well, just with the investing side of things, so they can take hold of their financial future and have a good retirement. We will plug everything in the show notes for you, and really appreciate you being on.
Yeah, Charlie, thank you for having me on. It's been good.
Absolutely.
Thank you for listening to today's show, brought to you by H&K Investment Group, your home for passive investing. If you want to learn more about how you can invest with us, please check out our website at hkigllc.com. Don't forget to like this episode and subscribe to our podcast. Please leave us a review to let us know how we are doing. Feel free to connect with me directly on LinkedIn or Facebook. As always, I'm your host, Charlie Hardage. Catch you next time.